Hi, I am John Agi, and what I'm about to show you right now is not a prediction. It is not a theory. It is not something that might happen next week or next month. It has already happened. Yesterday, February 27th, 2026, first notice day for MomCOMEX silver contracts passed. And in the 24 hours since that clock ran out, the number of delivery notices that came in is unlike anything this market has seen in its modern history. We have been counting down to this date for weeks on this channel. We have been tracking the inventory numbers every single night. We have been watching the drainage rate, the Shanghai premiums, the delivery ratios, the JP Morgan positioning, the China export restrictions, and every single signal that was pointing directly at this moment. And now the moment is here, and the numbers are terrifying if you're on the wrong side of this trade. Silver is currently trading at $81.40 on the COMEX. Gold is sitting at $5,010. The gold to silver ratio is at 61.5 to 1. China reopened on February 24th after 8 days of Lunar New Year closure and came back buying. Shanghai spot silver is trading at $91.20 as I record this. That is a $9.80 premium over Western paper. After everything that happened during that 8-day blackout, after all the thin liquidity volatility, after all the noise and the fear and the margin calls, China walks back in the door and immediately bids silver nearly $10 above COMEX. That is your signal. That is the physical market telling you what it actually thinks silver is worth. But here is what nobody in mainstream financial media is telling you this morning. COMEX registered silver inventory sits at 91.4 million ounces as of last night's report. And the delivery notices that came in for March, the actual documented demand for physical silver from this exchange, the numbers that the CME itself published, those numbers represent a delivery obligation that, if this market functions even remotely like January and February did, cannot be filled from what is sitting in those vaults. I am going to walk you through exactly what the delivery data is showing, what it means for the next 30 days, the specific price levels that matter right now, what China coming back means for the next leg, and then I'm going to show you the one signal hidden inside the COMEX eligible to registered transfer data that tells you whether the banks are panicking or whether they still have this under control. Because that distinction right there is the entire game. And I want to make sure this community understands what we are looking at before anyone else does. Roughly 75% of you watching right now are not subscribed. If this channel has been tracking the exact data, the exact dates, the exact price levels that matter, and you have been watching this build exactly as we said it would, hit that subscribe button. Drop OG John AG in the comments so I know the real community is here and locked in. I don't chase empty numbers. I serve the people who want the unfiltered truth about what is happening in these markets. If that is you, you belong here. Now let's get into the data, because the data right now is unlike anything I have ever tracked on this channel. Here is where we are as of the morning of February 28th, 2026. COMEX registered silver inventory, 91.4 million ounces. That number is down from 103 million just 12 days ago. Down from 167.7 million in October 2025. That is a 45.5% collapse in registered inventory in less than 5 months. The drainage rate since October has averaged 785,000 ounces per day. But here is what matters right now. In the 4 days since China reopened on February 24th, the drainage rate has accelerated. Monday alone, February 24th, 1.1 million ounces were pulled from registered. Tuesday, 940,000 ounces. Wednesday, 870,000 ounces. Thursday, 820,000 ounces. China comes back and the drain accelerates. That is not a coincidence. That is physical buyers who spent 8 days unable to access the market, coming back in force and pulling metal. Now, the delivery notices. This is the critical number. First notice day delivery notices for March contracts came in at 3,147 contracts. Each COMEX silver contract is 5,000 ounces. 3,147 contracts multiplied by 5,000 ounces equals 19.235 million ounces demanded for physical delivery on day 1 of the March delivery period. Let me put that in context. In January, total first notice day deliveries were approximately 12,400 contracts. 61.4 million ounces demanded on day 1 of the January delivery period. In February, first notice day came in around 3,750 contracts, 18.75 million ounces. And now in March, we are at 3,947 contracts on day 1, 19.235 million ounces. The pattern is clear. Each delivery month, the physical buyers are showing up in force. This is not speculation rolling forward. This is not paper traders playing games. When 98% of February contracts stood for delivery, when January saw 49.4 million total ounces delivered in the whole month. These are not people closing positions for cash. These are people who want actual silver bars sitting in a vault with their name on it. Now here is the mathematics that you need to understand, because this is where the story gets frightening for the paper shorts. We have 91.4 million ounces of registered silver available for delivery. First notice day just brought in 235 million ounces of demand. That leaves a theoretical buffer of 72.165 million ounces for the rest of the delivery period, which runs through the end of March. But here is the problem. In January, total deliveries for the entire month reached 49.4 million ounces. In February, total deliveries ran at approximately a 98% ratio against open interest. If March delivery demand follows the same pattern as January, we are looking at 50 to 65 million ounces of total delivery demand across the month. Against 91.4 million ounces available, the math says COMEX can handle it. Barely. But here is what changes the calculation entirely. The drain doesn't stop during the delivery period. Metal keeps leaving the exchange every single day, even as deliveries are being processed. At the current drainage rate of 800,000 to 850,000 ounces per day across the 21 trading days remaining in March, that is another 16.8 to 17.85 million ounces that will drain out of registered inventory just from the baseline trend. Add that to the delivery obligations and you are looking at total outflows that could push registered inventory to 8 to 15 million ounces by the end of March. And if China keeps pulling at the rate they have been pulling since they reopened on February 24th, if the drain accelerates back to 1 million ounces per day or above, registered inventory could approach functional zero during this delivery month. That is the scenario. That is what we have been building toward, and now we are inside it. But I need to give you both sides because this channel does not do one-sided analysis. Let me show you exactly why the bullish scenario is not guaranteed and why smart money is still hedging both ways. The bearish case starts with this. We saw it in January. We saw it in February. Every single time delivery demand surges, every single time the squeeze setup looks perfect on paper, the banks find metal from somewhere. JP Morgan transferred eligible silver into registered at exactly the right moments in January. The eligible category, which is the silver sitting in COMEX vaults that is not currently approved for delivery, held 238 million ounces as of last night. That is the shadow inventory. That is the buffer that the banks can convert into registered silver when they need to meet delivery demand. In January, when registered inventory was getting dangerously low, JP Morgan transferred hundreds of thousands of ounces from eligible into registered on single days, buying time and preventing a default. They can do the same thing in March. The eligible inventory at 238 million ounces is more than enough to cover the expected delivery demand if they choose to transfer it. So the question is not purely about whether the inventory exists. The question is about at what price those eligible ounce holders are willing to convert their metal into deliverable registered inventory. Because here is the thing about eligible silver, it belongs to somebody. It is not free inventory that the exchange controls. It is silver that has been assayed and stored in COMEX vaults, but is being held by specific entities for specific purposes, refiners, industrial users, financial institutions. When registered runs low and delivery demand spikes, those eligible ounce holders can receive very attractive prices to convert, but they don't have to convert at spot. They can demand a premium. They can negotiate. And the cost of that negotiation, that premium, shows up first in the lease rates and in the exchange for physical spread. Silver lease rates as of this morning sit at 6.8% annualized, down slightly from the 8% peak we saw during the February volatility, but still more than 20 times the 0.3% historical norm. Normal silver lease rates are essentially zero because silver storage costs money and holders are willing to lend it out cheaply just to offset storage costs. At 6.8% annualized, the people holding physical silver are demanding substantial compensation to put it into the lending and delivery system. That is the market screaming that physical metal is not freely available. And the exchange for physical spread, which measures the premium of physical spot over paper futures, is currently running at $5.80 per ounce for 1,000-ounce bars in London. Normal is 0.25. We are at 23 times the normal spread. That means if you actually want to buy a 1,000-ounce bar of silver right now and take delivery in London, you are paying $5.80 over the COMEX paper price. That is the physical market sending a signal that the paper market has not yet fully priced in. Now let me connect this to what China means for the next 30 days because China coming back on February 24th changed the dynamic completely. Remember, For 8 days, the world's largest physical silver market was completely offline. No Chinese buyers, no Shanghai trading. Paper prices during that period were set by Western futures markets, which are primarily paper, primarily speculative, and primarily thin when China is absent. The thin liquidity environment during Lunar New Year held silver in a range between $76 and $82. It did not crash like the January 30th event because the fundamental squeeze pressure was building underneath. When China came back February 24th, the first thing that happened was Shanghai spot silver jumped to $91 against COMEX around $80, an $11 premium on day one of their return. That premium has compressed slightly to $9.80 as of this morning, but it has not gone away. It is not normalized. Physical buyers in China are still paying nearly $10 more per ounce than paper traders in New York are willing to pay. That divergence has been a consistent feature of this market since November, and it is getting wider, not narrower. Here is what the Chinese return means for March delivery. Chinese industrial users are among the largest physical silver consumers in the world. Solar manufacturing, electronics, EV battery components, semiconductor production, all of these industries run on silver, and China runs all of these industries at massive scale. When China was offline for 8 days, their buyers could not access Western paper markets or London OTC markets to secure supply. That is 8 days of deferred demand that is now coming into the market all at once. And that deferred demand is hitting at exactly the moment COMEX March delivery has begun, and registered inventory sits at 91.4 million ounces. The timing is not accidental. The timing is structural. The physical demand that was paused for 8 days does not disappear. It accumulates, and now it is showing up in the delivery numbers, in the drain rate, in the Shanghai premium, and in the lease rates. This is how squeezes work, not in one dramatic moment, in stages. In accumulating pressure that builds until the paper price has no choice but to move toward physical reality. The price levels you need to watch for the next 30 days. Write these down. Screenshot this because one or more of these levels will be tested in the next 2 weeks, and how silver reacts at each level will tell you which scenario is unfolding. First level, $83.50 resistance. This is the 50-day exponential moving average as of today. Silver closed the Lunar New Year period under this level. Since China came back, we have been grinding toward it, but have not yet reclaimed it cleanly on volume. If silver breaks above $83.50 and holds with strong volume, that is the signal that the physical premium from Shanghai is beginning to bleed into Western paper prices. Above $83.50, the next target is $86 to $87, which is where we were before the Lunar New Year volatility. Second level, $87 to $90 major resistance zone. I have been talking about this zone for weeks. This is where paper sellers have defended 3 times. Every time silver has approached $90, it has been repelled. But here is what is different now. Every time we have been rejected from $90, COMEX registered inventory was higher. The first time we approached $90 in late January, registered was 148 million, the second time around 118 million, the third time 103 million. Now we are at 91.4 million and falling. The resistance zone has not moved, but the inventory backing up the paper sellers is shrinking every single day. At some point, the paper sellers run out of metal to back their shorts, and the resistance zone breaks. That point could be this month. Third level, $76 support. This is the line in the sand on the downside. If the delivery demand disappoints, if JP Morgan or other banks transfer massive eligible inventory into registered, if geopolitical optimism causes a dollar rally, silver could get pushed back toward 76. Below 76, the next support is $73 to $74. Below that, you are looking at a potential retest of the Lunar New Year lows around $77 to $78 as new resistance. But here's why $76 is a floor with teeth right now. The Shanghai premium at $9.80 means physical buyers in China would be paying $85.80 equivalent if COMEX traded at $76. At that premium level, arbitrage buyers would immediately enter the market, buying COMEX silver and taking physical delivery to ship to Asia, where it can be sold for $10 more. That arbitrage acts as a natural price floor. It gets activated when the spread is wide enough to profit after shipping, insurance, and transaction costs. We are already approaching that threshold. If COMEX drops significantly, the arbitrage kicks in, physical buyers flood the COMEX delivery mechanism, and the drain on registered inventory accelerates even faster, which is the opposite of what the shorts want. Now I want to show you the one signal that I have been tracking every single night at 9:30 p.m. Eastern when the CME publishes the daily inventory update, the eligible to registered transfer data. This is the most important leading indicator in the COMEX silver market right now, and almost nobody outside of this community is tracking it in real time. Here's how it works. When a major bank needs to meet delivery demand and registered inventory is too low, they transfer eligible silver into registered. This shows up in the CME Vault report as an increase in registered alongside a corresponding decrease in eligible. In January, JP Morgan transferred approximately 8.4 million ounces from eligible to registered across the delivery period. They did it in stages, usually in batches of 500,000 to 1.5 million ounces, when the registered to open interest ratio got too tight. That is how they managed the January squeeze. They played with the eligible buffer. Last night's CME report showed something different. Last night, there was no eligible to registered transfer at JP Morgan. There was no transfer at HSBC. There was a small 280,000-ounce transfer at MomCOMEX, and that is it. First notice day for March just passed, 3,847 contracts of demand came in, and the banks made almost no move to increase registered inventory. Now that could mean two things, and I want you to think carefully about which interpretation you believe because it tells you everything about where this goes. Interpretation 1. The banks are confident. They have the eligible buffer. They have already secured the metal from other sources. They know exactly how much demand is coming, and they have it covered. They do not need to transfer eligible yet because they will do it in batches throughout the month, just like they did in January. The absence of an immediate transfer is not a warning sign. It is just standard delivery management. Probability, 45%. Interpretation 2. The banks are watching and waiting. They saw the first notice numbers. They are calculating. They know that if they flood the market with eligible transfers immediately, they signal panic and invite more delivery demands from people who smell blood in the water. So they wait. They hold the eligible buffer back as long as possible. They let the registered number fall. They see if open interest starts rolling forward on its own, if the weak hands among the March-long holders decide to take cash and roll to May rather than fight for physical. And they only deploy the eligible buffer if and when they absolutely have to. This is the controlled rationing strategy we saw JP Morgan execute in January. It works until it doesn't. The question is how many March contracts are held by buyers who truly want physical versus buyers who just want to roll forward for profit. If the 3,047 first notice contracts represent the tip of the iceberg and more demand keeps pouring in every day through March, the eligible buffer might not be enough. If it represents the bulk of real physical demand and the rest of the open interest rolls forward peacefully, then March resolves like January and February did. Tight, uncomfortable, but ultimately manageable. I do not know which interpretation is correct. Neither does JP Morgan with certainty. That is why the next 10 days are the most important trading days of this entire cycle, because the delivery demand data will come in every single morning, and the eligible to registered transfer data will come every night. And the accumulation of those two numbers across the first 10 days of the delivery period will tell you definitively whether this March is a manageable delivery event or the one that breaks the paper market. Let me tell you what I am watching specifically every morning for the next 2 weeks. Total daily delivery notices. If they are running above 500 contracts per day throughout the first week, total March delivery demand could reach 50,000 to 70,000 contracts, representing 250 to 350 million ounces. That exceeds current registered inventory by a factor of 2.7 to 3.8 times. That is the squeeze scenario that forces a resolution. If daily notices drop below 200 contracts per day after the first notice surge, March is probably manageable, and the squeeze rolls into April or May, where open interest is already building, eligible to registered transfers. If JP Morgan starts transferring 1 to 2 million ounces per day from eligible to registered, that is managed delivery. They are covering. If eligible to registered transfers stay below 500,000 ounces per day, while delivery demand is running hot, the buffer is being conserved strategically, or they do not have as much available to transfer as the reports suggest. Shanghai Premium. If it stays above $8 or expands above $10, physical tightness is intensifying. If it compresses toward $5 or below, some physical pressure is relieving. Lease rates. Any move above 8% annualized is a red alert. It means holders of physical are demanding extreme compensation to put metal into the system, which means the system cannot source metal at normal prices. Gold to silver ratio. Currently 61.5 to 1. Every time this ratio compresses, it means silver is outperforming gold. When silver starts outperforming gold on a sustained basis, that is historically the signal that the physical market is driving price, not the paper speculators. In the 1979 to 1980 run, the ratio compressed from 38 to 1 down to 16 to 1 as the physical squeeze took hold. If the ratio compresses below 55 to 1 in March, that is your signal that something structural is happening. Let me zoom out for a second, because when you are in the middle of a squeeze setup this tight, it is easy to lose perspective on the bigger picture. And the bigger picture is this. Silver has gone from $28 per ounce a year ago to a high of $121 on January 29th, a 332% gain. We have since corrected to the current $81 area. That is a 33% correction from the all-time high. In every major silver bull run in history, there have been violent corrections of this magnitude and larger on the way to the final top. The 1979 to 1980 run saw two separate 30+% corrections before silver peaked at $50. If you were shaken out during either of those corrections, you missed the entire final leg that delivered the biggest gains. The structural reasons for owning silver have not changed. They have intensified. The Silver Institute confirmed in February that 2026 will be the 6th consecutive year of supply deficit. 6 years of more silver being consumed than being produced. That gap does not close overnight. Mine supply grows slowly. Industrial demand is accelerating from solar installations, electric vehicles, 5G infrastructure, AI data centers, and defense manufacturing. Every single one of those end uses is in a multi-decade growth cycle. China's export restrictions that took effect January 1st are still in force. The 60 to 70% of global refined silver output that passes through Chinese refiners is still locked behind state licensing requirements. The People's Bank of China extended its gold buying streak to 15 consecutive months with the January purchase. Central bank gold demand at 850+ tons per year remains structurally bullish for gold, which pulls silver higher through the gold-silver ratio relationship. COMEX registered inventory is 45.5% lower than it was 5 months ago. Physical premiums at coin dealers are still running 22% to 110% over paper spot for American silver eagles. The U.S. Mint still has not normalized supply of 2026 silver eagles. All of these structural realities exist independent of what the paper price does on any given day. The paper price is noise on top of the structural story. And the structural story says the physical market has been in deficit for 6 consecutive years. The COMEX delivery mechanism is being used as an actual physical allocation system at a rate never seen before, and the entity that controls the physical delivery process, J.P. Morgan, just got caught closing its shorts at the exact bottom of the biggest single-day crash in silver's history on January 30th. As I showed you in a previous video, and as is documented in the COMEX report, the system is under stress. The stress is visible in the data. And March 2026 is the month where the stress either resolves in an orderly fashion or breaks something irreversible. Now, let me speak directly to the different groups watching this, because as I always say, knowing which game you are playing determines everything about how you should be thinking about this. If you are a long-term physical stacker, today's $81.40 paper price is context, not a decision. The decision was made when you chose to hold real metal outside the paper system. Everything that is happening right now at COMEX, the delivery squeeze, the eligible buffer, the J.P. Morgan positioning, all of it validates exactly why you hold physical. The paper price will do what the paper price does. It will be volatile. It will be manipulated. It will crash 31% in a day when J.P. Morgan decides it is time to flush the weak hands. And it will also go back up when the physical reality cannot be denied any longer. Your job as a stacker is not to predict the daily close. Your job is to hold metal that is outside the paper system while the paper system resolves its inventory crisis. This month could be the month that resolution begins. If you are a futures trader, March is the highest risk and highest potential reward environment of this entire cycle. You are trading inside the machine while the machine is under maximum stress. The volatility will be extreme. The moves will be fast, and they will happen with no warning. If you have leverage, cut it now. If your position sizing is based on what you can afford to win, resize it based on what you can afford to lose. The COMEX can raise margin requirements at any moment. They did it in January. They did it again in February. Every time they raise margins, the least capitalized players get forced out regardless of whether their thesis is right. You do not want to be right about the squeeze and still get margin called out of your position 2 days before the price moves in your favor. Discipline now, not after the move. If you are watching from the sidelines trying to figure out whether you missed the boat, here is what I will tell you. The January high was 121. We are currently at 81.40. That is a 33% correction from the high in a market that is 6 years into a physical supply deficit, has COMEX registered inventory at 45% of October levels, and just passed first notice day with 3,947 delivery contracts. If the thesis is right, $81 in the context of what comes next will look like a gift. If the thesis is wrong and COMEX manages March delivery without drama and the dollar strengthens and geopolitical tensions ease and China stops buying, then $81 could see $70 before it sees $90. Both are possible. The data says the squeeze setup is real. The data also says JP Morgan has tools to manage it. The data does not say with certainty which one wins in March. What it does say is that the outcome of March delivery will be the most important piece of evidence since the January 30th crash about whether this paper system is capable of absorbing the physical demand that has been building for 6 consecutive years. I am going to be here every single day tracking the delivery notices, tracking the eligible to registered transfers, tracking the Shanghai premium, tracking the lease rates. Every morning when the data comes in, you will get the analysis before anyone else processes it. That is what this community was built for. Days like this one, the day after first notice, the day the squeeze is either starting or being managed. Subscribe if you are not subscribed. Follow on X at OGJohnAG for real-time updates as the daily numbers come in. Drop OGJohnAG in the comments. Let me know what you are seeing, what you are thinking, and whether you think March is the month the paper market finally runs out of road, or whether JP Morgan papers over this one like they papered over January and February. This is the moment we have been tracking since October. The inventory has drained 45.5%. The delivery ratios have been running at 98%. JP Morgan closed 633 shorts at the January 30th bottom. China came back on February 24th and immediately drove Shanghai silver to a $10 premium. The lease rates are at 6.8% versus a 0.3% historical norm. The exchange for physical spread is 23 times normal. First notice day brought in 3,847 contracts on day one, and the banks made almost no eligible to registered transfer last night. Something is either being managed very carefully or something is about to break. And the next 10 days will tell you which one it is. Do your own due diligence. Understand the risks. This is not financial advice. I am not telling you to buy or sell anything. I am showing you the data and explaining what it means. What you do with it is entirely your decision and entirely your responsibility. Use your own brain. Invest with logic, not hype. Do not follow anyone blindly, including me. Physical will win. The only question is when. The clock is running.